Hi, I'm Amanda Morrell, Personal Finance Editor with interest.co.nz, and this is Take an Interest in Your KiwiSaver, brought to you in association with AMP. I'm joined today by Chris Douglas. He's the co-head of research for Morningstar. Welcome back, Chris.
Hey, Amanda.
Chris is going to talk to us about the difference between active and passive fund management styles and the nuances and the performance and the various issues that go on under that. Chris, can you tell me what are the distinguishing features of each different style of management?
Sure. I think it's really important, Amanda, to point out there's many different ways you can skin a cat. So when it comes to investing, you've got what we're talking about today, which is active versus passive management. There's also other types of investing like growth investing, value investing, momentum investing. There's alternatives you can
dynamic.
Exactly.
Yeah.
All those things. So, but active versus passive funds management is very much it's a topical debate globally. Continuously a topical debate, and it's one where we're seeing a bit of divergence in KiwiSaver as well.
Okay, so I mean, you often hear that 60% of managers can't do better than the actual market itself. So what's the point in going active if you can't really chase those higher returns successfully?
Yeah, look, it's very, very difficult. And what we find when you think about the markets, it's a zero-sum game when you invest. So when someone makes money, there's a corresponding person or investor who loses money. And then when you actually take management fees into account, then the typical average active investor will actually lose money on an after-fee basis.
Mm-hmm. Well, that's the typical one, but the atypical one might actually do really well out of it.
Well, that's what we're hoping. And so I think it's really important to probably just talk a little bit more about what active and passive is.
Okay.
So when we're looking at passive management, a fund manager is just trying to get that market exposure. Mm-hmm. So they might be investing in the New Zealand stock market, global equity markets, fixed interest markets. They're just trying to get the passive market exposure. And I think one of the best ways for your viewers to understand that is when they're watching the news, the evening news at night. They'll show the daily return for stock markets globally. So the New Zealand NZX 50, the ASX 200 in Australia, the S&P 500 in the US. A passive fund manager is just trying to get that market exposure. They're just trying to tap into that return and get that return for the investors. Okay. They don't believe you can actually add value over time, on average, on an after-fee basis.
Okay.
And there's a lot of evidence behind this, pointing to what you said before about 60% of fund managers actually underperform the index on an after-fee basis. So active managers, though, they believe they can actually beat the market, and they try to beat the market day in, day out. We know on average that many of them don't actually beat the market on an after-fee basis, but the Holy Grail is trying to find that one that does.
Okay, but New Zealand is a bit of a unique situation. I understand that active managers here actually do better than the average.
Yeah, well, right? we've seen over a number of years now, the average fund manager has actually been able to outperform the index on an after-fee basis. And there's a couple of reasons, I think, for that. Obviously, it's been pretty easy for New Zealand fund managers to actually be short telecom versus the index. And that's actually meant to some relative outperformance versus NZX 50. Likewise, there's less liquidity in this market. There's probably more inefficiencies for a good fund manager to take advantage of. And we've seen global investors have probably don't have the information advantage on the ground and actually seem to have traded the New Zealand stock market poorly as well, and that's a way for local managers to take advantage of that. I don't know, maybe it's a distance thing, but yeah.
All right, the tyranny of distance.
Yeah,
it's
absolutely
maybe not such a bad thing in this case. So looking at the KiwiSaver space, how many managers are active versus passive? You've brought a list for us today, so we might be able to see a few here.
Yeah, sure. So I've got a list here that where I've just gone through the KiwiSaver providers on the Morningstar database and just giving you a quick snapshot about their style, whether it's active or passive.
Okay.
So there's two KiwiSaver providers on that list that are passive options. So that's the ASB KiwiSaver scheme and the SmartShares Smart Kiwi KiwiSaver scheme as well.
So they're tracking the index.
So they're tracking the index on the underlying sector exposures. I think the really important point to point out, though, Amanda, is that what we're talking about today is an investment style when you're actually investing within a sector. The reality is, though, is that a number of people have been doing videos over the last few weeks talking about KiwiSaver. Asset allocation is the key decision to make, and that's not going to be a passive decision. All KiwiSaver providers will be making an active asset allocation decision when they're investing, whether they're ASB KiwiSaver or someone who's active like Tower or Westpac.
Okay. Now, with respect to a blending of the styles, it looks like there's quite a few who employ both techniques here. And
Sure.
And have they done better for that, or how is it sort of stacked up performance-wise?
Well, yeah, look, again, their decision to go active or passive is probably not going to have a large bearing on what the performance has been, because it's been their asset allocation call that they would have made, which is actually going to have a greater bearing on their performance. And that's whether or not they invested, how much they invested in New Zealand equities versus maybe Australian equities or global equities, their exposure to fixed income versus other providers and things like that. And that's the call where we see the greater dispersion of returns, where the more the money's made or lost.
Okay, so you brought in some data for us, and it's 4-year performance data, which is interesting. I don't think anybody's got that out yet. So who has done well over the last 4 years per annum on an after-fee basis?
Sure, yeah. So we've got the Morningstar KiwiSaver Performance Survey soon to be released, and I've got the preliminary numbers here. So when you look across, I guess, the different risk profiles, the different categories, we've found the conservative options, which is where the default funds lie, have actually done pretty well over the last 4 years. You've got an average return of around about 4.25%.
Okay.
And that's per annum.
Yep.
On an after fee but not after tax basis, so it's before tax.
Yep.
But when you've seen the volatility that we've had in the markets, that more defensive cash fixed interest, where these funds they're dominated by that part of the market, and that's been the place to be. Once you go further down the risk spectrum and you're looking at the more moderate balanced categories, you're still actually getting a positive return over the 4 years, which is I think a pretty good result given the volatility. But then the growth and aggressive categories, they've sold off around about 1.7 to 2.9% per annum over the 4-year period.
Okay.
It's a loss, but quite frankly, it's not a bad result given the tremendous volatility that we had in 2008 and then again this year. So I think it highlights that by and large investors, it's been a tough time, it's been difficult market conditions, but by and large the KiwiSaver fund should have served them reasonably well.
For those active fund managers in a growth portfolio who have done above average returns, why would that be? Is that because they have a larger exposure to New Zealand equities, just relating back to what you said earlier, or what would be some of the reasons for that? Yeah,
look, there can be a number of factors that will be driving the strong performance. If you look at the last 9 months, the New Zealand market has been a strong performer. Over the last 4 years, it probably hasn't been. I think the Aussie market might have actually been a slightly better performer over that time, and so you might actually see the 4-year performance number, depending on the allocation between New Zealand and Australia, and even global shares as well. A big driver of returns over the 4 years has also been currency hedging.
Okay.
So when you think about investing into global equities, if you're doing it just buying from a New Zealand dollar basis, you've seen the Kiwi dollar rally quite significantly against the US, and as a Kiwi dollar rallies, you find that the value of your offshore investments actually goes down.
Okay.
Fund managers can offset that by actually having some currency hedges in place, and most of them do. But if you don't do that, then again, it's going to that would have a detrimental impact on the performance.
And so you were saying most of them do. I know mine doesn't, but they've actually done quite well. So what would account for that? If you don't have that hedging, is that just really shrewd allocation?
Well, no, see, you're right. I mean, maybe some strong stock selection has driven performance. When you're looking at the performance drivers, there's been a number of different developments in the markets over the last 4 years that actually could drive it. I think, but obviously, yes, stock selection, the asset allocation call that managers made, it's been a smart call, obviously, Amanda.
I guess you put a lot of trust in your provider to make those calls. There's not many people probably be brave enough to make them themselves, but for those who were, can you sort of make your own asset allocation through KiwiSaver? Are there any funds where you can do that yourself?
Look, there's a couple of places where you can actually decide on the allocation between maybe a conservative fund or a growth fund, and you can decide on the mix there and make your own call. Likewise, there's a few smaller options out there where you can actually pick your own stocks as well. So for the true do-it-yourself investors, we're starting to see more of that come to the market. And as I think the KiwiSaver, as funds grow, you'll see more providers looking to give them their investors more choice in that regard.
And that would be the open architecture framework.
Yeah, exactly. The open architecture framework, where it's more of a menu and you can pick and choose your funds and maybe even some shares as well and how you want to allocate to them.
And possibly mix them up between providers as well.
Yeah, absolutely.
Yeah.
Yeah, it's a lot harder. You've got to be willing to spend the time, do the due diligence, do the research, and understand what you're getting. But for sure.
Yeah, well, always do your research. If you need some help, you can come to Morningstar or our site as well. I'm Amanda Morale, personal finance with editor with interest.co.nz, and I've been joined today by Chris Douglas, co-head of research for Morningstar, and this has been Taking Interest in Your KiwiSaver, brought to you in association with AMP.